welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifel and Scarlett Fu. We are almost there.
We're almost there, but we have some big economic data points to get through this week.
That's true. There's a lot to look forward to. Let's get to the biggest stories right now in the nearly $19 trillion global ETF industry. It's the last full week of trading for the year, and stocks wiping out their gains in the session as investors prepare for that delayed U.S. jobs report.
BlackRock's Jeff Rosenberg will have his eyes on that jobs report. We'll also be speaking to him about the data and the firm's newly launched liquid alternatives ETF.
Plus, in a moment, we will speak with Valerie Grimba from RBC Capital Markets about the flows inside and outside the United States. All that and more coming up, but as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. The flows are a little wild just right off the bat, so this is going to look shocking. $40 billion into VU, that didn't really happen. A lot of this is rebalancing. At the end of the year, there's a lot of tax loss harvesting. There's the rebalancing of the indexes. The flows get a little funky. Probably, though, VU would still be at the top anyway. So it's not directionally wrong, but this will come out. Anyway, SPY here, that's pretty good. A lot of people will use this to tax loss harvest. Look for SPY to have a big December. IWM, oh, here we go again. Small caps. We'll see if 2026 is finally the year for small caps. SPYM, this is another S&P. Interesting, this thing just hit $100 billion. This is the mini-me to SPY. It's the cheaper version, 2 basis points, and it's growing pretty quickly. We'll see if we can get up to the VU IVV level. VTI, no shocker. Growth, and then equal weighted. But I've been hearing calls about, oh, we got to get away from the Mag 7. This is how you would do it. Didn't work last year, maybe it'll work next year. Let's look at the outflows. And you can see that IVV is also very shockingly weird at $44 billion out. Again, that'll probably come back in and neutralize, again, a lot of, we'll call it operational flows going on. Money out of LQD, money out of JAW, that's interesting. JAW had another big year. We didn't talk about it much, but it's still in the top 3, I think, of fixed income ETFs in flows. TLT, money out of that. A little bit out of ITOT, a little bit from the TQQ. Anyway, largely speaking, a lot of net inflows. We're at 1.434 trillion on the year. Let's look at the rest of the world. Our first guest is from Canada, so I thought we would look at where Canada ranks in this year's flow race. And the answer is 4th place. Here's a look at the countries after the U.S. that in flows, right? So at the top here, the UK, believe it or not, is the biggest flow getter outside of the U.S. at 150. This is China, which actually is one of the rare countries that didn't hit a record, although the year's not over. If the national team buys ETFs, that'll go back up, but they're there. This is Canada right here, just over $100 billion. That's France, that's Germany, France, et cetera. So Canada, a little over $100 billion. Scarlett, again, everybody had a good year. Canada in particular, punching above its weight a little bit.
All right, thank you so much, Eric. Joining our conversation now is Valerie Grimba. She is Director of Global ETF Strategy at RBC Capital Markets. So where does this set us up for 2026? Because it feels like we've seen 3 straight years of very solid returns in equities, and you wonder how much more we're going to get out of this in 2026 and what that means for ETFs as a result.
Absolutely. And Scarlett, I would say the trend is your friend. And I think the trend is more higher, more launches, more flows, a lot of structural things happening in the industry. ETFs have really had a coming of age type of year, banner year, and I think that trend is going to be sticky and remain in place for 2026 as well.
Well, let's talk about that a little bit more as it directly relates to the United States, because we've been talking about the triple crown, as Eric has been calling it, that you think about U.S. launches, trading volume, and flows all hit a record high in 2025. We haven't seen that since 2021. We all remember what happened in 2022. So Eric, I believe we had this conversation last week, thinks that this could be a near-term top, and I just wonder if you agree with him.
I would say I disagree, actually. There's a lot going on under the surface, and I think it depends a lot on market forces. Listen, this job is exciting because every day things change, and probably predictions and estimates also change going along with that. So, there could be some kind of unforeseen black swan situation that happens next year, and I'll be wrong and have to come and admit that. But right now, I think everything is going one direction. That can be a problem sometimes in finance, but I think these are structural shifts that are happening underneath the surface, and that's going to beget another kind of banner year next year as well.
So one of those triple crown metrics is volume. That's the shocker this year, because normally volume spikes in bad years, because the previous record was 2022 for volume. That was a bad year, and that's when flows and launches go down. So it's hard to get all 3. This year volume, okay, April was rough and March, but that's about it. What do you attribute to the volume, given you're a market maker? Was it just more tickers, more action, the degens? What put it over the edge this year?
I would say it's probably a combination of the two you just mentioned, and then a little bit of je ne sais quoi, animal spirits, but definitely more tickers. So again, you're just kind of increasing the base, and then you're increasing usage, and then you're increasing use cases of ETFs. So all of these multipliers are compounding effects. You had some volatility early in the year. We saw this trend in Canada as well. Record volumes by a large amount, actually. So I think just continued adoption, continued increase of ETFs and trading ETFs. We love that as market makers. Will kind of beget increased volumes in coming years as well.
Speaking of more tickers, one of the big themes we've been talking about this year is the ETF share class of mutual funds and how that's going to be a game changer for ETFs as a whole. From a market maker's perspective, what are some of the potential headwinds you see here that maybe people aren't discussing enough of?
Yes, I think that's a great question, and I'm always happy to come in and help educate people, especially asset managers that have never trafficked in the ETF space before. They're used to mutual funds. These are not traded intraday on a market with market makers investing or trading in their products. And so really our technology is scalable. The trading technology has been built so that you can continue to add tickers and provide daily quotes, two-sided quotes on tickers. But there are some finite resources in the system. One that's very important is, of course, a balance sheet or capital that is put up by market makers to interact intraday, and also the capital that's deployed to provide seed capital to launch ETFs, and then seed capital or balance sheet that we also put to work when trading ETFs. So that is a finite resource that probably is going to be constrained if you see the number of ETFs grow.
It's interesting to hear this perspective, obviously, and you would know. So let's talk about how this plays out, because I'm taking a look at the notes you sent over to our producer talking about the potential for a bottleneck if we see ETF launches ramp up as a consequence of share classes coming through. What does that bottleneck actually look like? How does that play out in the industry?
Yeah, it's just our market makers are going to be more selective with the ETF issuers that they work with. ETF market making itself is not a very profitable business. Razor thin margins, very hard to eke out P&L, and it's very, very competitive, as you know. So ETF market makers like to work with asset managers that they have a partnership with. They work with on rebalancing. They work with on providing their derivative structures in place. These are other areas of the trading floor that they can work on an economic relationship. And so we just want to make sure that even the smaller, more innovative ETF asset managers are able to come to market and not be hamstrung by us just working with the largest providers.
I want to actually stay on this topic here, which you call the Ghost in the Machine.
Yes.
Which is a good Police album reference, by the way.
Thank you.
Yeah, I know you.
I appreciate that.
Okay. Anyway, this is a thing I heard too from Chris Hempstead, actually, who is a market maker. He said the number of ETFs is going like this, and the number of lead market makers has been static. So the gap is getting bigger. Can't you just throw money, like these big mutual fund companies, can't they just throw money at this problem and get more market makers to sign on? Like, how's that work?
It's not that simple, again, because the economics don't make sense on the market making piece. I have in there Rule 5250 is a FINRA rule. You're prohibited for paying directly for market making. So the market maker itself needs to make sure there is an economic relationship with the brokerage or the dealer kind of elsewhere to make it make sense for us to put up our capital and our balance sheet and to really invest in making sure your ETF is tradable and has that liquidity that all these asset managers really want.
Before we let you go, this year has also been the rise of active, especially in fixed income. You see that continuing, this trend, this move towards active, but in what other asset classes are we going to start to see that really pick up steam?
I think we're actually just kind of going back to the passive versus active question as an existential question. And I think we're going to redefine what truly is passive and what truly is active. So of course, passive, you think of VU or just NASDAQ 100 bench to an index. But I think when we talk more about quantitative strategies, different alternative strategies, again, the list goes on and on, how we define active. And I think we're going to see a continued rollout of these more sophisticated strategies within an ETF wrapper.
In your role, you have active managers from the old world,
yes,
from the 90s, coming to you saying, I'm going to do this ETF.
Yes.
How in denial are they? Because I have found it's going from a country club into the Amazon jungle. It is a brutal awakening for most people. Do you have to coach them through hey, might want to lower your fee, it's not as easy,
yes,
got to show your holdings every day?
It is a painful part of our job, and it's a very real part of our job. Every day we're kind of walking back expectations. Again, saying this is a highly competitive area. You can't just come in here with a song and dance and a track record and expect it to sell or fly off the shelves. It's a very, very dog-eat-dog world in the ETF landscape. I think that benefits end investors, but we do have to definitely set expectations when it comes to.
Don't you call it the
ETFs.
Terror Dome?
I do, and that's why. It's brutal.
Yes.
It's hell for issuers, but heaven for investors.
It's brutal out there. Valerie, great to get some time with you. Really appreciate you coming by the studio. That is Valerie Grimba of RBC Capital Markets. Now, coming up, my interview with BlackRock's Rick Rieder and Steve Lapley on the future of private credit ETFs. That conversation next. This is ETF IQ. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where we highlight the stories and trends that caught my eye. And this week, we only have one, and that is that Eric and I last week were part of Bloomberg's annual ETFs in Depth event. Now, part of the event focused on private credit ETFs, and I spoke specifically with BlackRock's Steve Lapley and Rick Rieder about the group's potential for growth.
If your question is, can you have 100% private credit in, as a standalone ETF? I think that's challenging. I think that, when we look at the wrapper versus the underlying, people like to think of, well, the wrapper has to just, go around the underlying and then somehow it'll work. I do think there's a bit of a tug here, a push and a pull, where the underlying market has to evolve as well. Right. And so it needs to get to a place of transparency and not necessarily, liquidity is a relative word, but there needs to be, more evolution in trading, market structure, et cetera, before you could say, oh, sure, you could have, a standalone product with 100%. We're not there. And so we continue to watch it, and we continue to think of different, concepts around, what's the best way to deliver it. But it's challenging to say, here is a standalone 100% private credit product at this point.
Yeah, that's really interesting. Rick, to Steve's point that you've done this in the mutual fund wrapper, having that slice of private credit. That's something that you can do in the ETF. JP Morgan, for example, has a filing out there where private credit would just be a little bit of a slice of a total credit ETF. But I'm curious, how you think about that. Would you ever put, that up to the 15% illiquid cap in an ETF?
So, I think if you fast forward 5 years from now, I think the concept of private and public, I think, will be completely blurred. Today, when I look at an asset, we look at what is its beta, its dispersion, its marginal contribution to risk, what's its liquidity, and then what does it do in the portfolio. Today, saying Steve made the point, which is 100% right. In fixed income, our goal is to get paid back. And we run very different in fixed income than we do equities. Like, I believe you diversify fixed income. When you take public-private, this number is staggering to me. There's 1.4 million unique fixed income securities. I run a big equity portfolio. I got to watch 30 stocks, basically. There's 1.4 million. If I could use privates, now in the ETF structure, different than a mutual fund, I'm trying to create something that is liquid, replicatable. So I try and keep that number smaller. By the way, it's part of why mutual funds are not going away. Oof. Like, your ability to actually
get... This is the ETF crowds.
I understand. But it's actually, listen, the benefits are ETF. ETFs are going to grow much faster, and Steve knows way better than I the efficiencies and the reasons. It's going to grow much faster. But I just can't put as much in the ETF as I would in the mutual fund. So what do? I give up a little bit of yield.
And that was Steve Lapley and Rick Rieder over at BlackRock. Really interesting conversation. We've spent a lot of time this year talking about private credit ETFs. Lapley pouring a little bit of cold water on the idea that, you can have a pure play 100% private credit ETF.
But we already have something that tries to mimic private credit returns, right? PRIV is the ETF that was finally launched after, well, it was launched, but then there was some drama around it. What have we learned from the launch of that ETF?
I mean, it's an interesting question because you think about all of the hype that there was for this ETF PRIV, and it has about $96 million in assets, which is certainly, respectable for a brand new ETF, but it's not exactly the asset levels that you might have expected relative to, just how much excitement there was for this to go live.
Yeah, totally underwhelming, I'll just be honest. And it was hyped, and also, there's a lot of other fixed income products that give you the same metrics. What's on the flip side, the private equity ETF, XOVR, which only has 8% SpaceX, has $700 million, and it's from a no-name issuer. That tells me there's way more unmet demand for private equity, which I think most people can relate. And the pop with getting a private equity before an IPO like SpaceX is so tremendous that they will buy it. This is much harder sell, in my opinion, and harder to differentiate from other bond ETFs.
Yeah, there's a use case for those private equity
Yes.
ETFs in a way that perhaps people puzzle over.
And a shiny object potential.
All right. Well, we're going to stick with BlackRock because coming up next, Jeffrey Rosenberg will be joining us to discuss the firm's newly launched ETF that's focused on liquid alternatives. And just a reminder, you can listen to Eric and Joel Weber on Trillions, their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu here with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at a hedge fund ETF, basically. So this is the iShares Systematic Alternatives Active ETF. So this is, you know what hedge funds are, right? So this is going to try to get you low volatility, higher Sharpe ratio. So it's not going to move around a lot. It's going to be pretty tame. It's pretty new. It just came out already, 70 million. That's promising for something that came out just, 2 weeks ago. The fee is 99 basis points, so priced like a hedge fund. And then let's look at the allocation. So you're going to see a lot of stuff on here that is just all different asset classes. So it's basically a multi-strategy, go-anywhere type hedge fund. You can see it does. This is a lot of stuff going on DES4. Normally it's a little less. So that just shows you how much it's doing. You probably won't look at this and get a real feel for what it does, but just know it's, again, trying to deliver hedge fund type returns. Let's look at this category. So the multi-strategy hedge fund ETF category has always had a tough time. You can see QAI has been the leader for a while, but the whole category is only 2.5 billion. That is tiny for a 15, 20-year-old category. The reason is equities and bonds have just done so well. People tend not to look for alternatives. So the market environment's been tough, but also, Katie, there hasn't been a lot of big fish in this space. So maybe BlackRock can jumpstart this category.
Absolutely. Thank you, Eric. Joining us to talk about this ETF, I'm pleased to say, is Jeffrey Rosenberg. He is Senior Portfolio Manager of Systematic Fixed Income over at BlackRock, and of course, one of the managers on this new ETF. Great to see you in person.
Great to see you. Great to be here.
So let's talk about this new launch, because I'm taking a look at the name, I'm taking a look at your website. You say that IALT combines the potential for alternative investing with the convenience of an ETF. What about this is that alternatives exposure?
Yeah, so a number of things. So first of all, there's a lot of confusion around alternatives, the discussion you were talking earlier with my colleagues about private credit and different alternative asset classes. That is not what we're talking about here. We're talking about alternative strategies. And what Eric talked about, hedge fund like strategies is really what we're anchoring on. And what does that mean? It means long, short, market neutral investing, right? So when you think about what we have available to us in the ETF world, and again, Eric's segment, how small this category is, because investors in this wrapper haven't had access to these types of strategies. And what's differentiating about these strategies is they get to what's underneath the surface. Right, so much of what we talk about in markets, we've talked about over years in markets, are rates going up, are rates going down, stocks going up, do you like AI, do you not like AI? But there are so many other things happening in financial markets underneath the surface, and that's what we try to get at in this fund through a long portfolio, through a short portfolio, and taking out the market directionality, with the idea, basically, that This can lend another source of returns through investing in all the stuff that's underneath, both on the long side and the short side, different than the market directionality in the markets.
So how do you fit this into your portfolio ideally? It checks the alternatives strategy list, but I wonder what you give up exposure to in order to make room for this.
Yeah, so this is about, again, going back to what Eric said in his segment, why hasn't this been a big category? Because beta exposure has been great. People have been really happy with beta, but they've been so happy and so successfully rewarded with their beta. What's happened to their beta, right? The other story, it's incredibly concentrated, like the most concentrated we've seen, top 10 stocks, right? So people have a lot of concentration in their portfolios. So one of the questions for 2026, and I think it's a huge theme, is how do I diversify my portfolio? Not our old conversation of like stock and bond diversification, but how do I diversify my equity portfolio? Because just by owning market cap weighted benchmarks, I'm incredibly concentrated. So what iAlt, I think, slots into portfolio construction, because we aim for a higher risk target on this fund. We have more ambition in terms of the risk budgets that we're allocating to the various strategies. This can target an equity-like return and substitute for equity exposure, and that's a way of diversifying without, key point here, without having to make a call on, is it the top of the market, is it a bubble or not a bubble? Very hard things to do. This allows you to diversify away from that by, again, getting access to that alternative strategies of long-short market neutral investing.
So with advisors, you've got to sell them on why they need alts. You got your work cut out for you, but it's possible. Now, institutions would already understand this. They like this stuff. But to them, I find them a little elitist. They want the real hedge fund for some reason. Like, they don't want it in an ETF, which feels like the public pool. How do you overcome that selling to actual institutions?
So it's a segmented market, and you're right. There's a understanding of sources of returns, right? So if you really understand how is my portfolio manager delivering returns, then you look at, okay, I want to have diversified sources of returns, and the most diversifying source of return is true alpha. But there is very little true alpha in the world. It's very hard to deliver. It's also why it commands such a premium price in the institutional investment universe, because there's a recognition of what is true alpha versus what are other forms of outperforming. Outperformance is not alpha, because I can outperform by out-yielding. I can outperform by out-risking. That's a tilt, and there's a lot of that goes on in the world. Retail, and this is what the opportunity is to grow that category, is to really grow the appreciation of, if I add alpha in my portfolio, and the challenge to us in the producers of these products is to really demonstrate true alpha and not just another tilt product. That's what we're doing in iAlt by taking from our institutional expertise, modifying it for what fits within the ETF wrapper and ETF ecosystem to make it work and available for retail investors.
All right, Jeff, unfortunately, we're up against the clock. Really appreciate you coming by the studio. That is Jeffrey Rosenberg of BlackRock. You can read all about this drill down when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. This is Bloomberg.